Corion Report comes out as per usual at the end of every month, and it gives us an insight in what happened the month before. May 2022, David, 4 weeks ago, we were talking about one of the worst months in history. And actually, that decline continued for the first 3 weeks in May. Thankfully, things turned around towards the end, thankfully for people who were getting a bit nervous about their portfolios. But when last did we see a 7-week losing run like was experienced during April and May?
Thanks, Alex, for having me. Yeah, I think you have to go back to 2001 since the US market has had 7 weeks of negative returns, and it looked like it was going to be an eighth week, as you said. If you look at the Corion Report this month, you'll see equity markets, slightly and marginally down, but that certainly doesn't tell the full picture. It was almost like a roller coaster. You were down 8 and then up almost 8. So it was a hell of a ride to be pretty much flat.
For the month as a whole, even though that's interesting. So it's more than 20 years since we last had a extended run like that. And what do you guys do within an asset management company when you just see equity prices continuing to slide? I suppose 1 week you get it, 2 weeks, when it goes into 7 weeks, as we saw in this most recent run. How does it affect the psychology within the firm?
Well, our clients at Corion expect us to take a long-term view. So we go back to following our investment principles, which is very much valuation based. And more often than not, when the markets are down, and at I think it was the 20th of May, the US market was down more than 21%. It was in bear market territory. Those are the times where you often find opportunity, and you need to, ignore the rhetoric out there, the negativity, and look at it from a long-term valuation perspective. And we certainly were nibbling mid-month. We weren't rushing in because certain parts of the equities are still arguably at high valuations, but certainly it does present opportunities, and you need to be able to take advantage of those opportunities.
So let's just get the overview from you. What stood out for you in the month of May that we're now looking back on?
Well, I think if I look at the managers who performed and didn't perform, it's pretty much a similar story of the last few months. It's those managers who had conviction and were generally value biased in managers that were at the top of the ranking tables. And after 10 years of being the laughing stock of other investment strategies, it's look who's laughing now kind of thing at the moment, because they really are doing really well, the value managers, and those who stuck to their principles and investment beliefs and stayed through the full course of time are starting to reap those rewards.
It has been a real sell-off, though, when you have a look at some of, particularly the big tech stocks. In the Corion Report, you give us a figure there of 46% down from their peaks, the big tech counters?
So that's the biotech. We made reference to the S&P biotech index. So that's definitely the coalface of risky assets, assets that are priced for future earnings. So when you have a sell-off and potential for rising interest rates and rising risk, the rates at which risk is priced, generally those are the assets that come off the hardest. But as you said, a 46% decline is massive. We actually had a look at that this morning in our investment meeting, and a lot of those companies in that index are actually trading less than their cash value. So yes, risk has gone up. Potentially, a lot of those companies aren't going to get the future earnings that investors expected. But when you have such a fall and you have these companies with significant cash on their balance sheet, the question that we ask ourselves is: this not the time to be nibbling at these counters?
Just explain that, David. Their share prices are lower than their cash value.
Yeah, so because these companies are highly, the opposite of cash generative, that they burn a lot of cash because they're deploying that into research, etc. You can find a situation that we are in the moment that if you look at their market value, the price in which you can buy and sell the companies on the stock market, and you compare that to actually the cash they had on their balance sheet, you're actually getting a discount for some of these shares. So the market is saying, well, yes, we know that. Is it a buying opportunity, or will this R&D and research and potential future earnings play out, or will it just burn the cash that's at presently um, in the company's valuations? It is, if you look back in history, a period where I don't think that the amount of companies in this index have traded at such low valuations. So, we're thinking that the 46% decline is potentially a buying opportunity.
I want you to just help me through this thought or this thesis. The world has speeded up. We know that it's really now changing or transforming at warp speed. And you would presume that the same thing happens in markets. Something that would take months, even years, as an upswing or a downswing, a bull and a bear market, might now be compressed into shorter periods of time. We've had a massive sell off in stocks in the US, particularly the high flying shares. Can we start believing maybe that the worst is over, or how are you guys reading this?
So yes, the drawdown has been significant. If you look at the Nasdaq, for example, the S&P, there's been some sharp reversals. I think you're down probably, the drawdown's probably 14, 13%, 15%. But if you look at the Nasdaq, for example, over the last 5 years, it has still given you a compound return of 20%. So even with this drawdown, you take a bit of a longer term perspective and longer term view, you know, it's been an asset class that's performed very, very well. So what does that mean? Well, where are we now? Well, we still got to look at valuations and the prospect of future earnings. Go back to, almost come onto this planet like the past is the past, and what do you see lies ahead of you? And we think that, especially on those asset classes, the riskier asset classes, the asset classes that have been bought for future growth prospects, are still on the expensive side. So we are definitely seeing opportunities in the market, but probably not in the growth tech part of the market.
So, getting back to May again, what funds did well? You've given us the insight that it was value funds, but was it particular parts of the value spectrum?
I think both globally and locally, it was a broad-based value shares that did well. Value shares tend to have an exposure and overweight to financials, which you saw the South African Financial Index outperforming resources, so that makes sense. And also in energy shares. So although gold and certain parts of the resources got hit heavily, and there were certainly some shares, oil's still going to record highs. It got back to $120 per barrel. So, energy plus financials generally do uh, are value kind of shares, and those generally perform well during the last month.
And if we looked at the other side of the coin, which funds struggled in May?
It was the complete antithesis. It was those growth funds, those momentum funds, those funds that have really done well up until, I would say, beginning of the previous year. So those funds that, momentum driven investment process, those funds that, look for future growth down the line, and which is an investment strategy that has worked over time. But when you have rising interest rates environments, rising you're discounting those cash flows back at today's value at higher rates, that investment strategy, becomes a little bit unstuck.
There's always a debate between active and passive funds, actively managed and passive funds. In other words, those that fund managers take different bets on and buying simply the index. Are we seeing any change in that equation, given that the value stocks are now outperforming their peers?
I don't think enough changed, to be honest. And the popularity of passive shares and passive investing is here to stay. And I think there are too many active management houses that are, quite similar to passive benchmarks or indices. And at Corion we call them flock stocks. The stocks that you feel comfort, you feel warmth, you all together. You can't really be fired for owning some household names. But if you want that, then really go passive. So I think it's an opportunity for the active management industry in South Africa to distinguish themselves a little bit more, be a little bit racier in terms of their conviction, because that's ultimately what they're getting paid for.
So, looking forward, where are you investing now? You gave us some insights a month ago. Are you still looking at bonds?
That's played out nicely for our clients. So South African bond market has done well. We also bought bonds when treasuries were a lot higher. So yeah, we still similar view that we need to almost deploy a diversified approach now. We're not quite sure what's going to win in terms of the debate between significant inflation and how to tame that versus the risk of a slowing economy and potential recession. I mean, the bond market at the moment is sort of in the middle and trying to work out that debate for itself. But we think it's time for probably not to have too much brave asset allocation calls, a more of a neutral position, but to be nimble, be agile when markets prices come off, be prepared to buy, and if it's into a rally, pretty much all across the board, try and trim a bit. We predict volatility, and those asset managers that are able to profit and be agile, we think will add a bit more value to their clients.
And also looking into the future, certainly the feedback we got in Davos was that the Ukraine war isn't going to end anytime soon. And if this is the scenario that you work into your predictions or into your forecasts, let's just say that the Ukraine war continues for years rather than peace breaking out in months. How's that likely to affect the whole investment scenario?
Well, I think always got to take that into account with what the market is expecting in terms of its current pricing. We think that that is generally priced into the market. I think most market commentators, most market investors seem to think that this is going to be a long drawn out war. And we think that is reflected in terms of current pricing. So we don't think that's really going to be a detriment to the way markets behave, because we think that is the central theory as things currently stand.
So, if on the upside there were to be an early end to the war, then asset prices might recover a little.
Correct, and that's with all investing. You're looking for what's not priced into the market, and there are some emerging markets that have been particularly hit. Some funds that had exposure to Russia, those instruments and investments have been drawn down to zero. What happens if the world surprises us? To invest in anything that's worth zero and pay pretty much zero for it with the potential of upside. I mean, those are the things you should be looking for all the time. They don't exist too often, but perhaps this might be a case that you can find some funds with exposure to those kind of investments, and you'll benefit down the line.
And just to close off with, lots of people watch the currency. How did the rand perform? And I suppose, as importantly, its major cross, the US dollar, in the month of May.
The dollar was strong against most currencies. If you look at it versus all major asset classes, the dollar continued to be strong. We were no exception. The rand slightly depreciated. So the central theme, I mean, we looked at a chart today about how the yen has performed versus the US dollar over the last 10 years and the last 3 years. Generally being strong dollar has been the central theme, which makes sense when volatility is up. The dollar is the real safe asset where people go to in times of uncertainty.